If you're a prospective homeowner, you surely know how daunting the task of deciding which house to buy can be. It's overwhelming to sift through listings and schedule viewings. What's worse is you could spend more than needed due to hidden costs. This guide will help you navigate the process rather than figuring it out alone. I'll focus on the many hidden costs that could be easily avoided if you're aware of them. Avoiding preventable errors will help you buy your dream home strategically and affordably. Rest assured, this video is here to help you navigate the process of buying a new house by focusing on the many costly mistakes new homeowners often make. Let's not waste any more time and jump right into it. Welcome back to PST Finance. First off, it's important for you to remember throughout the whole process that you're not necessarily going to live in whatever house you'll buy for the rest of your life. In fact, statistically speaking, many people tend to move at least once at some point in their lives. So first, ask yourself whether you're sure for some reason that you're going to live for a very long time in the house you're looking for, or whether you will be willing to sell it and move somewhere else a few years from now. Planning for the future in this way will help you make a series of important decisions regarding where to buy. First, you should take a look at the housing market in the area you're considering before deciding to buy property there. The reason is simple. If your plans include selling your house in a few years, you want to make as much money as possible when you do so. But this would be difficult in some areas. Suppose you bought a house in a remote town where only a few live. The housing market in such a place would be so small and stale that you wouldn't be able to get competitive offers for your house. It's recommended then that you buy a house in a big city with a population of around 500,000 people or more, especially if you're looking to make a profit or just break even after moving in the future. Another closely related factor is the appreciation value of your home. It's true that betting on appreciation is never a surefire way of making money and isn't an essential strategy for real estate investors. This is because many variables are involved in the short term, and a lot could go wrong. For example, an economic recession or a natural disaster could tank the value of homes in a certain area. But this doesn't mean it's completely irrelevant. In the long term, houses have historically increased in value by 3% to 5%, which is good for you if you don't plan on moving anytime soon. Moreover, depending on the neighborhood, the stability of the market, and the number of people flocking to your area, your house could see a notable increase in value in just a few years. Generally speaking, do your homework and research the area you're buying in. Now that you've thought about your future plans and the area you want to live in, it's time to start thinking about your budget. Check your credit report and try to get pre-approved for a mortgage from your bank. This way, you will have an initial idea of the price range you want to stay within. But be careful, the amount you get approved for isn't necessarily what you can really afford. Sometimes, banks can give you a mortgage that you can afford in theory, but will force you to live on a tight budget. Use the pre-approved amount only as an estimation, and don't aim for more than you can afford. Remember that you could always sell your house and move somewhere else, so don't aim for the most expensive house possible because you feel like this is a lifetime investment. It probably isn't. Now it's time actually to look for a house. It's crucial to be aware of the many costs involved in the process. Many people think that the mortgage and down payment are everything they need to care about, which couldn't be further from the truth. We'll get to the hidden costs in a bit, but first, let's start with the more obvious ones since even those aren't so straightforward. You should save up for a 20% down payment. The bigger your down payment, the more money you will save on monthly payments, which can be a lot. To see why, note that most of your monthly payments go toward paying off the interest rather than the principal. Let's illustrate with a numerical example. Say that the total price of the house you will buy is $440,000. Assume it is a 30-year mortgage plan with an APR of 3.42% and a down payment of 20% or $88,000. The principal you will have to pay in such a case is $352,000, and the total interest value will be around $211,385. This makes for a monthly payment of around $1,565. On the other hand, if you make a 15% down payment, which is equal to $65,000, you'd be required to pay around $1,900 monthly. That's $330 more than the first option. This means that basically, if you pay $23,000 less for your down payment, you will lose more than that in just 6 years, and your total loss will exceed $118,000 at the end of the 30-year term. This increase is to be accounted for by private mortgage insurance, PMI. This is typically required when your down payment is less than 20% and can get quite pricey. With that said, it's not an absolute rule that you should always save for a 20% down payment. It all comes down to your financial situation, but it's something to keep in mind anyway. And don't think about withdrawing from your emergency fund to cover the down payment. Needing to buy a house is usually not an emergency. To learn more about how emergency funds should be used, though, make sure to check out our video on the topic. On top of this, the monthly payments we talked about don't account for property taxes. Yes, you heard that right. Property taxes are not part of the mortgage itself, despite many people thinking otherwise for some reason. Property taxes obviously vary from place to place, and researching them is part of your homework. This is not to mention the monthly cost of homeowners insurance, too. One way of dealing with this is to get a 15-year mortgage plan as opposed to a 30-year one, because interest typically tends to be lower in the case of shorter-term ones. Further, you could always consider refinancing your mortgage for lower interest rates. It goes without saying that you should do a lot of research to find and compare different interest rates and payment plans offered by different lenders. So far, we have been discussing the costs virtually everybody knows about, which have turned out to be quite tricky. It shouldn't be surprising that there are other factors you should be aware of that prospective homeowners often don't think too hard about. The most notable of these is repair costs. When you go take a look at a potential house, don't focus too much on easily replaceable stuff. It's too easy to feel like the house is in perfect condition when it has new curtains or freshly painted walls, but you should be on the lookout for things like plumbing, cracks in the wall, the condition of the ceiling, etc. Many new homeowners pay significant amounts of money on renovations that could have been avoided. Always find a good home inspector to help uncover problems with your potential future house. And things can also vary quite a lot depending on the area. If it's snowing where you're at, don't go inspecting houses now, since a lot of issues may get covered up by the snow, and the inspection process will overall be too difficult. If the area is in danger of getting flooded, take flood insurance into consideration and see whether the state of the house can withstand floods. And that's it for today's video. Now you know what to remember and watch out for when you buy a new house. You also know how to raise your chances of making a profit if you decide to resell it in the future. Which of these tips did you find the most helpful? And what was it like to buy your first house? Please share your thoughts with us in the comments down below. And don't forget to like and subscribe for more content like this. See you in the next video.